All right, everybody. We'll make sure everyone can hear us. Good. All right. So we are getting going right now, guys. It is almost 9:30. We're gonna get kicked off right at 9:30. So to give you kind of another reminder how this works is we're gonna run through this market update. It's a compressed, compiled information of just kind of highlight um, the highlights of the previous month and year to date, and we're just going to kind of recap King, Snohomish, and Pierce County. Those are the tri-counties that primarily Heaton Dainard focuses on. Again, interest funding will lend money throughout Washington State. So if you do have a deal outside the tri-county, by all means, give us a ring and we can get you all funded up. But we're going to kind of dive into this real quickly. I'm going to kind of hammer through this in the next 20 to 30 minutes, and then we're going to open it up for questions, and I will stay on until all the questions are done. So we'll give it one more minute and then we will get going. I'm actually, as we're sitting here, I'm looking for deals because we need more deal flow. And I feel like the market's picking up too. So we're trying to time it right. That's actually, here's one right here that I'm looking at. All right. Well, I'm going to take a pause from my deals and we will get this kind of kicked off. So first things first, who am I? I'm James Dainard. I've been an active real estate investor since 2006. Myself and Will Heaton, we've been kind of known as the recession flippers. We've been buying and selling in Washington State for the last 18 years, all different types of market conditions, including this weird one that we're in right now. So since founding our company, Heaton Dainard Real Estate, we've actually done over 3,500 transactions with investors just like yourselves and over $1 billion in real estate investing. So that's all we do at our shop is we are an investment brokerage. We work on math. We look on margins. We look for cash flow. We look for development flips. That is our bread and butter. So what we're going to be covering today is our just kind of a March overview of the Tri-County, King, Snohomish, and Pierce County. We're going to talk about interest rates, inflation, and then just kind of general investment trends, which we've seen move quite a bit over the past 30, 60 days. The market is definitely shifting again. It has gone from like a sudden compression to where things are getting pretty stable and selling off. So we're going to kind of recap all those stats right now, and then we'll talk about kind of what we're seeing. I think right now we have a total of like 50 listings or so, or we have 19 actives, and we have, well, I way overshot that. We got 35 listings and about 15 pending. So, but we have a good pulse on all the markets because we're selling stuff in all different price points, all different counties. And so we can kind of get a really good gauge and read on what's going on with the market outside these stats that we're going to talk about right now. So what's going on with Washington State as a whole? So right now, the median home price is at $655,000 for March. Or the high was at 655,000 in the past 12 months. It's currently at 587,000. So it is down 6.8% year over year. And one thing I want to point out is these year over year stats, as we were putting this together over the last couple of days, they look a little bit more aggressive than they actually are doing right now. We're actually seeing the market improve quite a bit. And so those are things to just keep in mind. If you're not doing that well on an investment, though, and you bought it 12 months ago, that's why. If you're down 6.8% year over year, that's going to have some impact on your values, your cash flow, and then how much money you got to leave in the deal when you go to refinance a rental property at that point. Homes for sale are at 18,448 for the state. Which is down 6.6% year over year as well. So inventory is shrinking. Homes that sold under list were 31.6% of all homes sold last month were sold under list price. And so that's something you definitely want to be paying attention to as you're looking at your data, you're looking at your information. You know, if you're seeing something pending in the market, what is it pending at? And is it something that is an actual real sale at that point, so really call around, dig in because you want to know where those kind of sales are falling. And then the average days on market is at 25 days, which is up 16 year over year, but I think that's down 6 from last month. So we are seeing the days on market start to shrink backwards right now, but a dramatic jump from 12 months ago. Because one thing to keep in mind is April was kind of that peak market that we saw right before rates started getting rapidly increased. And so we're going to see a lot more skew in the numbers right now. But the overall health of the market is staying pretty consistent. So 2023 King County median home sale price was at 769,000. That's down 9.18%. Pierce County median home price was at 530,000. That's down 4.1%. And the Snohomish County's median home price is down to 685, which is down 9.39%. So as you can see, King County and Snohomish County, there's an affordability issue going on here. They're about 10 to 20% higher than the median home prices in Pierce County. And so we've seen the compression come back a lot harder because it's just more expensive. And it's hard to buy homes with these high rates. And so in the more expensive markets that we've seen, or ones with higher median home price, those are the ones that kind of shrunk a little bit quicker. Um, so Tri-County quarterly comparison right now. So right now, home prices in Washington were down 6.8% year over year in March. At the same time, the number of homes sold fell by 33%. So there is a lot of there's a lack of transactions. That's 1/3 the amount of transactions going on than there was a year ago today. And the number of home sales were down 33.5% year over year. So what's happening is there's not a whole lot of inventory. There's not a lot of good inventory, that's for sure. And then the amount of transactions that are going on because stuff's still expensive, the money's expensive, and the properties aren't that great. And so things are just kind of slowing down in general. Median home prices at 587 and then we're at 25 days on market, and there's been a 6.6% decrease in supply year over year. So again, there's not a whole lot of stuff to buy. So King County, which is primarily where I do a lot of my business, inventory is up though 22.2% from February 2023. Or I mean, excuse me, from March 2023. The March median home price was 769,000. The number of sales decreased kind of in par with the rest of the state at 36%. And part of that is, like I was just saying, there's not a whole lot of good stuff in the market right now. And so it's like either buyers are going to wait for that right house, or they're going to wait for pricing to come down. And there's a lot of stuff just kind of floating. I mean, right before I got on here, that's what I was looking at. I was looking for the floater deals. What's been sitting on market for a while, it's overpriced. There's a lot of that junk in the market, which is going to throw some of these stats off. Days on market are at 12 days, which is +7 from a year ago, which seems like a big increase, but that's down roughly about 12 to 13 days from where it was the previous month. So we are seeing days on market shrink drastically right now. I mean, that big of a drop in the last 30 to 60 days makes a big impact. And so what that's causing, because the properties are now moving quicker, it's causing a psyche to change in a lot of King County, where we're starting to see multiple offers again. And when people, when the buyers and the consumers are starting to see the market level out, which is happening, um, they start to have to pull the trigger a lot faster. So that's why days on market are shrinking up. In addition to, there's new inventory coming to market, new construction, flip properties. Those properties are moving quick because there's just not a lot else that you can buy. I know right now, I think we just sold property in Edmonds. We were the only thing for sale. If you wanted a nice house in that price range, you were going to buy us. And so the lack of inventory is causing things to move a little bit quicker. 29% sold at a original list price. So that's not a whole lot. So, buyers are still looking for opportunity. Think about that as you're getting ready to price your product. There's kind of two ways to price things right now. I think in King County, you either come a little bit under market, and then people get in a little bit of a frenzy over it. We just had a couple multiple offer deals go on, or you price in your negotiation into your original list price. And I think what that comes down to is what's going on with the activity of what you're trying to sell. If I'm selling something that's a little bit more expensive, where the market times are 60, 90, 120 days, I might price it a little bit heavier. If things are transacting inside that 12 days or less, where the average days on market, I'm going to probably maybe go a little bit lower to see if I can generate that big group. In addition to, make sure you're calling all listed properties to find out what their activities are, because their activity will tell you whether it could get driven up on price. Um, but overall, in King County, we're actually seeing the market get a lot healthier. We are selling things rather quickly. So Pierce County is down 4.1% year over year. Median home price is at 530,000. Inventory is up 8.1%. And then number of sales decreased by 28.4% year over year. And then days on market are at 22. So they're up 17 days from year over year. So Pierce County is still taking a little bit longer to sell off things, but that 22 is down from, I think it was about 31 the prior month. So we're seeing in both counties about a 30 to 35% drop in days on market. That makes a big difference. And as you're underwriting deals, you can plan for that in your dispo. And it really showing that the market's actually starting to almost swing again the other way, or to really level out and be consistent to where you can kind of operate that as an investor. And then 38.3% sold above original list price. So that's what we were talking about before, is the market is picking back up. Things are actually starting to get bid up a little bit as well. I know for us, it's been tough to buy cheap product. The stuff that's a little bit more expensive, there's a little bit better margin on those things. But if you want something cheap for fix and flip burr, buy and hold, I mean, the margin is still a little tight because there's a lot of demand and there's not a lot of inventory there. So Snohomish County is down 9.39% year over year median home price. That's at 685,000. Inventory is up 8.3% from last month. And then numbers of sales decreased 35%, and days on market are at 17, which is down again. Very, very consistent data in all three counties. It's down about 30 to 35% from where it was last month. Overall, it's up 12 days year over year, but to be at 17 is really healthy. That means the market is moving. If we're below 30, we're doing pretty well. And so even though the market may seem a little slow right now, at the end of the day, it has all the healthy signs for moving product. And then 33% sold above original list price. So what's going on with our listings? A lot of our stuff that's listed is fully renovated. It is in pristine condition, which typically means you're going to be going for the peak high end of the market, which we have been seeing. Some of the stuff a little bit more dated, that's clean and very move-in ready, that stuff's been transacting fairly well because it's about 10% cheaper. Even though homeowners really can't afford to renovate these homes after they buy them, they're still opting for the cheaper, affordable payment. One thing we have seen, though, if you're doing it to the nines, that people want to pay for that quality. It makes them feel better about having that higher payment because they're getting a much better product and quality all the way through. On average, our showings across the board are about 4 to 5 weekly. So that's about double where it was at from the beginning of the year. So we're seeing bodies come through more and more. I know in the east side alone, we're seeing a ton more bodies. I think that's up probably 300-400% on the amount of people showing right now. And so we're seeing some life going back into our listings, which were really slow for that last quarter four of 2022. So the fact that that's turning around is a really, really good sign. Average days on market for us are at 34. So that's about 35% higher than the average. Again, the reason being is we are going to the high end of the market. We are not the sellers that are in that median home price. We're outside that median where a lot of transactions are going on. And then currently, about 60, 90 days ago, a lot of our offers were coming in anywhere between 3 and 5% off list. Now they're coming in between 2 and 3%, if not getting full list, if not above. So again, we're seeing days on market shrink closer to list price. We're staying more pending right now. And so the overall things are moving. All right. So now we're going to talk about interest rate and inflation. So inflation. So the good news is, or the bad news is, inflation is still rising, but the good news is they were anticipating inflation to come in around 5% in March, but it came in at 4.3, so lower than expectations. And I know a lot of times it's up 4.3%. That doesn't sound good, but anytime that we're coming below the Fed's expectations is always a great sign. The reason being is they're the ones that are anticipate what's going to happen over the next 6 to 12 months. So if it's coming below, if the market's looking healthier than they're forecasting, that's going to kind of indicate that they're going to take their foot off the gas with these rate hikes. And the less money costs, the better for real estate. And so, those are definitely things to be watching. The inflation rate, the labor market's still pretty tight right now, though, and that is causing inflationary items. And so, I would say outside the just core CPI index, definitely be checked on the labor market as well. The annual inflation rate for the U.S. slowed to the ninth consecutive period, so it's a good sign with just the trends going on to 5% in March, or is it 4.3 to 2023, the lowest this is the lowest since May 2021, which was at 6%. So these are again all good. These are all good signs, right? Inflation is slowing down. It's coming below expectations. That's going to get more health. It's going to get our economy kind of more back under control. That's going to kind of indicate that the Fed's going to take the kind of foot off the gas for the rate hikes. So what do we think is going to happen with rates on the next Fed meeting? People are anticipating about a quarter point hike on the forecast. So remember about 9 months ago, or it wasn't even that long. Yeah, about 9 months ago, they were doing 3/4 point hikes, which had a lot bigger impact. So we kind of got through that first tough 6 months where they were really stepping on rates. Now they're going into a slow kind of roll up, which is causing the market to level out. And we're seeing that impact today on all of our listings and sales. So rate hikes have slowed down. The federal funds rate currently right now is at 5.83%. So that's going to put us right about 5% by the end of the next rate increase, which is what they were kind of forecasting through the quarter 2 and 3. So it is staying with the forecast, which is good because the problem was 9 months ago, they would give us forecasts or anticipations of what they were going to do, and then none of it would go down the right way. And so the fact that it is starting to go the right way is a good sign. And then as of Sunday, April 16th, the current interest rate for Washington is 6.85 for a 30-year mortgage and 6.13 for a 15-year mortgage. Those are the averages. The 10-year Treasury yield is at 3.52% compared to 3.45% yesterday. So we're seeing a lot of consistency in the Treasury yield. It's been floating in around that 3.5 for a while. It is up quite a bit. It's up, roughly a point from where it was a year ago, but we're seeing it kind of stay consistent for the last 90 days or so. And then Freddie Mac forecast the 30-year mortgage is going to start at 6.6 in quarter 1, which it was there. So again, I'm kind of watching their forecasting, and they're saying it's going to be around 6.2 by quarter 4. I have seen some reports anticipating like a 5.75, which would be even better. But those are all good forecasts to be tracking as you're getting ready to dispo any type of property. As investors, we are buying property, increasing the value, and then timing the disposition. So as you're looking at buying those deals, going into that next big fixture, maybe not it might not be a bad idea, because the longer your deal will take, the lower your rates will cost. And if you're selling something in 12, 9, 10 months that's got a lower rate than it is at today, in theory, that property should be worth more money. But as you're underwriting deals, buy on today's numbers. Make sure you're staying pretty conservative. But if the rate is fall, that could be some upside in those deals where there could be some real big treasure at the end of that. So impacts from rates, we're still seeing longer market times. We talked about that. They're about double to triple the time they were a year ago. But days on market shrinking 35% over the last 60 days. That's a huge deal, guys. So things are transacting a lot quicker. We're still seeing a little bit of irrational price drops, not as much as we were seeing where people were panicked and cutting price 10, 20%. Buyers are still being selective. We're seeing a lot more buyers in the market, but they are being picky, right? Their mortgage costs 40, 45% more. They want to make sure they're getting the house. People are really trying to, that saying of marry the house, not the rate. They're really thinking about buying this house right now. They're slowing down. And so if they fall in love with it, they know that the rate's short term, but they got to fall in love with it. All right, so our current strategy at Heaton Dainard Real Estate right now. So over the past 60 days, we've seen, I've referenced numerous times, a mass increase in showings. Homes are selling closer to lists. We're seeing multiple offers, and contingencies are still kind of being remained. So the overall health of the market is doing a lot better. And those are trends that we're watching as we're underwriting deals. We were underwriting deals pretty conservatively the last 90, 120 days, and we're starting to tighten that up a little bit because if you want to be a player in this market, you still got to be aggressive. If there is no inventory, that means it is a novelty product. You're never going to steal a novelty product at that point. But you can definitely mitigate risk going into these. We have a lot of economic unknowns going on. We're still increasing our hold times on our average when we're looking at performas. We're still adding 5 to 10% construction contingencies to all of our budgets. We're focused on the cluster comps, not the outlaying ones. So if we have one random high comp, but the rest are clustered in a certain median price, we're going to stay with that kind of values. We're using the most 60-day recent comps. We were doing that really to stay ahead of the trends. We were doing that to stay ahead of the trends if it was kind of dipping a little bit the last 5 months. But now we're seeing a rebound a little bit, especially in certain pockets like Bothell, Kirkland, Linwood. We're seeing a bounce up, a little bit of a bounce back. And so those are all things that, we want to stay in front of the market because we also don't want to be missing opportunities. Market is constantly moving right now. It's going up and down, up and down. We still have a heavy emphasis on pendings and active values. That's where the market is today, and we want to know what the pulse is today. And then right now, from 13 to 15, we're at 15 to 17% anticipated returns. To where the opportunities, we're still seeing a ton of deals. I just bought one in West Seattle. If you know how to do heavy fixtures, there's buys out there. And so I would say if you want to mitigate risk, it's kind of weird, right? You buy the most jacked up house to mitigate risk, which doesn't sound right. And it doesn't really, it can kind of spook people, but those are the ones with huge margins in them right now that have a lot of learning curve. The property that we just bought was 645,000. It's worth 1.4. That's a good buy. Or sorry, we paid 740,000. It's worth 1.4. That's 50 cents on the dollar, but it comes with a ton of hair, right? We're going to have that property for 10 to 12 months. But the margin's there, so I can stay very safe. And that's how a lot of what we were flipping in 2008 was. We were going after the massive fixtures with huge margins. That way, if anything happened, we could absorb it in our equity position. Development land, there's still a lot of opportunity there. It's down 30, 35%. And then another thing that we're kind of focusing on is we're talking about marrying the Burr property. Remember, rates are temporary. A lot of these deals that don't cash flow that well, they may look like a 4 or 5% cash on cash return. If rates even fall a point, the return goes up to 10 to 12%. And we do think rates are coming down. Rates are temporary. And so looking for those Burr style properties where we can get big equity positions that can break even. We know that those are going to turn into high cash flow deals in about 12 to 15 months. All right. So forecasting for investments. For those who do not watch the On the Market podcast, make sure you do so. We talk about all these trends for your forecasting. So On the Market by Bigger Pockets. Right now, it's still a seller's market. There, with inventory as low as it is, if people want your house, they're going to have to work with you on it. Also, writing up these offers, guys, like you're not just going to take a deal because there's no buyers out there. There are buyers. There's a lot of investor transactions going on right now as well. And so, make sure you're running your numbers right. Run it on the numbers, not off what you think is going to happen. Opportunities have been increasing a little bit, especially on the major fixers. Single family fixers, you hear me talk about that a lot. We've increased our margins by 10%. And we're getting them. So there's definitely buys on that right now. Development, like we just talked about, is down 30, 35%. Multifamily is still right now, pricing is staying pretty heavy. I was just talking to somebody about a duplex in the east side, and for the price they want, if I put 300 grand down, I would still lose 1,200 bucks a month. That doesn't work. And so what we're seeing in the small multifamily side, there is some opportunities, but they're not very many. And then you just got to be patient. A lot of sellers are just hanging on to their pricing. They're not moving and they're just kind of sitting on it. And then we have seen higher cap rates in the larger product across the board for multifamily. So we're going to wrap up our presentation right now. Again, you guys, we just try to make it a quick hitter for you guys once a month. We will be doing this next month, recapping April. And if you have any feedback for us, definitely let us know. We can talk about whatever you guys like. For more information on the market and what's going on, definitely go to our Instagram at Heaton Dainard and J Dane Flips, LinkedIn for Heaton Dainard and James Dainard, and then on YouTube at Project RE. Oh, and one other things too, guys. So for the last couple of years, we've had a lot of people asking us to roll out a detailed fix and flip course, which we have not done. We are launching one though, and it comes out in 4 weeks. And so if you're a Heaton Dainard client, you get this for a deal and a half. So make sure you reach out. It's an 8-week course where I'm going to be taking you guys through 8 hours of training, 8 hours of questions, and then a lot of different video updates and training on what's going on in today's market with flipping houses. I know the last couple of years, the market made us all look really good, but it's really about digging. Right now, as we're going into a flat market, that means executing your plan correctly is essential. If you cannot execute your plan, you will not make money. And so make sure you check that out. If you have any questions on the course, please send us a message and we will get you the information. But it will be an awesome time. So now what we're going to do is we're going to kind of open it up for questions. I will hang on until all the questions are asked or answered. And then once the questions stop rolling in, we will let you guys go on with your day. Any questions, guys? Or is it a light day? Yeah, I never know. Either it's going to go on for 30, 40 minutes or it's going to go on for 5. So we'll see what we got today. Well, Vic asks, tell us more about the course. That's a great question. So you guys, what the course is an 8-week training class with me. It will be a community-based. So we're going to go over 8 different topics. The first one's going to be intro into flipping. The next 3 will be on one is on underwriting your deal, going through step by step on how to protect your investment, how to underwrite it to highest and best use, property sourcing, how to get more deal flow as a flipper. We're going to talk about design and construction management, about how to design your property for a fraction of the budget and also manage it to where you're staying in budget or staying on top of your costs. And then we're going to be doing a lot of focus on funding your deal, joint venture agreements, all the stuff that we do in our current business. And the really cool thing about this course is it's going to be constantly rolling, is we're going to be changing this. The problem with courses is someone rolls out a course and then everything changes. And what they're doing in that course doesn't work anymore. Or they were a master of that section of the course for a segment in time. Whereas we've always been buying for the last nearly 20 years. Good market, bad market, whatever market it is, we are buyers. And so, but what that requires us to do is pivot, change, and make adjustments in our business, or we can't continue with that business. And so you're going to be constantly getting the updates, how we're pivoting things around, how to get your deals fund, how to be systematic in your daily process and what you're going to be doing. And then, so it's an 8-hour course where we're going over in detail. And then it's going to be 8 hours after once a week. We're going to be hopping on for an hour call, going over the course, going over the information. You're going to be asking me questions about specific issues you may be having or questions that you have about building that process out. And then we'll have a community board as well where everyone can kind of just bring their questions and just send a synergy. And, at the end of the day, we're all trying to make money in this flipping game, and it changes every month. And so relying on each other is really, really important. But for more information, go to jamesdainard.com and then go under courses and you can sign up. And if you are an existing Heaton Dainard client, make sure you shoot us an email. We'll get you a link. We'll get you a little thank you. Vic asks, would you recommend this course prior to getting into flipping or in parallel? I would say the more education you have before you get into flipping is always a good thing. I learned a lot of hard lessons by having no training and no education. And so I could have prevented a lot of losses and mistakes if I would have had a little bit better training. So I would say get on it right away. You can do it in parallel, but I would say try to get through the course, and then it will definitely get you going in the right direction, because there's things that you should be doing today before you even get into flipping. And we're going to talk about this all in the course. You don't The problem with it is people kick it down the road. They're like, I'm going to get to that next. I'm going to get to that next. But there's stuff you should be doing today to build that out. So if you keep kicking the can down the road and you don't make changes today, you're never going to get on that horse. Or when you do, it's going to be extremely risky. And when this business goes bad, it goes bad in a major way, and it can be very, very costly. So I would get on it immediately. And Vic, thanks for letting me shamelessly plug my course. Good questions. All right, any more questions, guys? All right. Well, I'm going to give it another 30 seconds, and then I'm going to let you guys get on with your Tuesday. So now I got some meetings going. We're getting our project that we just purchased in West Seattle going. Got another one I'm trying to close. If you have any deals, bring them to us. We're buying. Also, a 1031 exchange. I need a rental property ASAP. Been looking in the east side. I need a place to stay too. So if you guys have anything, let me know. Another question is, last question. Would this be applicable for BRRRR strategy as well? Assuming yes. Yes, this is the BRRRR strategy. One of the key components of it is renovating the property, adding value. And if you don't have a good control on it for your BRRRR, that's going to mean, the less control you have in your rehab means more money you have to put in the deal, which means less money, which increases your basis, which means you get a lever less and can really affect your returns. So being a good flipper will make you an optimal BRRRR investor. And you guys, well, Vic, I hope you come out to our course. Yeah, I think we are putting all the energy into this. So this is not going to be your generic fluff BS crap that everyone keeps selling online. I know I hate to say it that way, but it's we're putting a lot of time and energy into this. We want people to leave feeling like they just got 10x what they paid for. So hopefully we see you there. And then I'm gonna kind of let you guys go because the questions are wrapping up, and we got stuff to do on Tuesday. I got to go get some more deals. So hopefully you guys, one other thing too, if you have not came in and met us at the Investor 101, please do check us out. And then thank you to all of our sponsors, which we're related to, but Heaton, Dainard Real Estate, Intrust Funding. If you need any hard money or funding on your next deal, definitely reach out to Intrust Funding immediately. Or if you are a wholesaler and investor and you're trying to generate your own deals, check out EasyButtonLeads.com. We're now doing skip tracing as well. It's a fraction of what it costs. You can save yourself 20-30% on your skip tracing by going there. So EasyButton Leads. All right, guys, I'm going to let you guys go and crush the week. Go get a deal. And if you do, bring it to me.